Over the last year, the price of gold has been grinding higher as one of the most unloved equity market rallies took many benchmarks to record highs. And with the recent wobble in equity indices as we went into the beginning of February and as bond yields tick up, where now for the precious metal and how can we trade and invest around any change? Well, the fund manager from the Junior Gold Fund joins us now, Angelos Damaskos. Angelos, welcome back. We've spoken to you before about the gold markets, but here we are now at the beginning or week into February's trade. We've got this wobble in the equity markets. Gold is trying to edge higher. What's your message for those that use gold as a solid foundation for investment purposes?
Well, Jeremy, thank you for a start, for inviting me. Gold has always been perceived as a safe haven asset and a protection, offering some protection against volatility, against other classes, and it proved its worth during the financial crisis of 2008, when it retained its value much better than any other asset class that got decimated. And even in that environment, gold actually did drop somewhat in the whole upheaval of the financial system. In this scenario, it's still early days, of course. We have seen the first wobble last night in America was a pretty dramatic sell-off. I tend to think that it's the beginning of something more serious because the equity markets have run up so quickly and so high over the last few years. Yet gold retained its price and has started inching up again this morning. We are trading now at 1340 or so. It seems that there is a band of investors who are looking for this safe haven aspect of gold as security for the portfolios. Now, this is, again, early days. If this sell-off proves something much more sinister and much more medium term in its intensity, we could see the generalist investors looking again for the safe haven of cash and alternative safe haven assets, and that could prove a change of sentiment in the allocation of gold in any portfolio.
Let's bring the chart back up. We had it up while you were just talking. This is a weekly chart, and you can go all the way back to the highs that we saw, the record highs in September 2011 of just shy of 2,000. Why should we be interested in gold in this age of the internet? We've got Bitcoin now that many are saying has taken away some of the advantages of holding gold. There are other alternatives now to store wealth. Why should we be bothered with something that, quite frankly, doesn't give a return?
I think there has been the usual signals of a market topping over the last 6 months. And the example in this case is Bitcoin, that went up to $20,000 per coin in December and now has crashed more than 60%. And these are things that become a fad or a fashion of the time and are chased by speculative investors that have absolutely no relevance to the long-term fundamentally driven investors. And these type of investors who constitute the majority of the market, including pension fund managers and including the general wealth managers, have considered gold as the traditional safe haven asset. And these are the type of investors that go into ETF that are backed by gold and would be looking to change their allocation as if this volatility and this sell-off proves something more significant.
Last year, I understand that gold demand overall, physical gold demand, fell. Is that not again another indication that gold is losing its attractiveness?
Not necessarily, because I think the statistics offered by the World Gold Council indicate that actually the traditionally buying nations who look to gold as a safe haven, that is China and India, have been big buyers. They have increased their buying. Somehow there was a slight slackening in demand from the developed economies, and I attribute this to the strength of the equity markets. When the main indices hit all-time highs successively, and you are making such good money in quality industrial companies that also offer you a very healthy yield, why would you hold an asset that doesn't offer you anything. In fact, it has a cost for storing.
I just want to take a look once again at this chart, this weekly chart for gold. Technically, how do you analyse this? What do you want to pull out particularly?
Well, the important thing of this chart, that's the longer term chart that shows how we have lost value from the highs of 2011 all the way down to 1100, just above 1000 in fact. And since the beginning of 2016, we have seen a recovery rally that has had its volatility as is expected, but it's forming this very interesting ascending triangular pattern. And we believe that if we break this resistance point of about 1365 to 1370 per ounce, gold will easily raise up to 1450 per ounce and possibly 1500. And that could be a major catalyst, or at least a psychological catalyst for investors to buy into junior and medium capitalization mining companies of gold, because they are significantly underrating their value in relation to the gold price.
Why small cap and mid cap? Why not large cap like Randgold, and why not the big players?
The large caps have been the favorites over the course of last year. There have been significant flows of generalist and specialist money going into the large caps last year, which have outperformed the rest of the sector. And I think my interpretation is that investors, again lulled by this false sense of security of the main markets, have disregarded small cap stocks as being classified as more volatile and more risky, and have shunned them out of their picture. Now, as the valuation gap becomes apparent, that smaller caps are so undervalued in relation to the larger peers, investors are likely to look into them as a diversifier.
Let's take a look at a couple of stocks within your portfolio, the Junior Gold Fund, that you like the look of at the moment. What do you want to talk about?
Well, during the course of last year, we restructured the portfolio of the fund somewhat, because from the early 2016 to the sort of October period, many of the then small cap companies that we held massively outperformed and became mid to larger capitalization. And I believe always that our fund's concept is to offer this operational gearing to our investors to the gold price. And therefore, we have recirculated part of the capital into some of the smaller, more prospective companies that had yet to participate in this rally. And two of them among the several holdings that we chose provided significant outperformance. And I think it is just the beginning in their development. The first one I wanted to point out is a company called Cardinal Resources. It is listed both on the Australian Stock Exchange and on Toronto. And it has an important asset called Namdini in Ghana that it has developed from under 1 million ounces of reserve to over 8 million today. But most importantly, last week it announced a preliminary economic assessment for this project that indicates the significant value should it be put to production. So it is putting the production into the sights of the company, and obviously it becomes a much more attractive takeover target for a mid-cap or larger company that wants to improve their production going forward. So
this chart, we're just at some interesting support at around about the 45 cent level. Highs recently seen as high as 74.
That's right.
That was in October last year. So we've seen a bit of a depreciation in share price. Where do you see this going?
I think the weakness in the share price was in anticipation of the results of this economic assessment, because people naturally are cautious before such an important announcement. I believe that at the moment it trades at valuations metrics that are half that of its peer group developing companies, and therefore on the back of this very solid study, a lot more investors will look at it seriously, and possibly much bigger investors will look at it now as a serious portfolio holding.
Stock number two?
Stock number two is a much smaller company. It's actually an earlier stage company developing deposits in Mexico called Minorum Gold. And that is a company that we have backed for a year now from a much earlier stage, because we saw the founder team as being a very strong team of geologists. The key founder is a man called Peter McGough, who is credited with the discovery, among other deposits, of the Juanicipio mine of mag silver. And also David Jones, who is credited with the discovery of Los Filos. So they have a lot of credibility in their experience and their understanding of the Mexican landscape. We are talking now about Mexican-specific silver specialists. And they have gradually, over the last 2-3 years, have accumulated a very, very interesting and attractive, very well located land package where they have started drilling during the course of last year, and they have produced some remarkable results. And I believe it could be the next Mag Silver, this company. It could be just the beginning. It has been re-rated significantly over the last couple of months on the back of these amazing drilling results, but I think it is just the beginning.
Price action quite often takes into account future expected progress of the company. Have we not done all of the upside we're going to get for the time being, or do you think there's more?
No, they continue drilling. I think it's a very large horizon that they are exploring, and it could be a very interesting deposit. And naturally, as they prove it up and they produce successively good results, then they become much more attractive for joint ventures and other partnerships by the larger peers who operate in their vicinity and their neighborhood.
Yeah. Okay. All right. Interesting. Talk about a couple of stocks in your portfolio. But thanks indeed for joining us, Angelos Damaskos, the fund manager of Junior Gold. The Junior Gold Fund has as its base those junior producers and explorers in some of the safer parts of the world. Angelos Damaskos joining us there with a look at the gold price as well as we look out to the rest of 2018. Subscribe to IG for educational content, company insight, financial analysis and expert commentary.